Gary, thanks a lot for joining us today. Can you explain a bit more what you're doing, what your firm is doing in your background?
Sure, my pleasure. My background has been both in the long-only value space as well as the alternative investment arena. I was basically very instrumental in finding talent in both those areas for a couple of firms previously. And today, Absolute Equity Managers is basically investing in managers that we think can deliver close to absolute returns as much as possible. It's not easy, but we've also had examples of managers in the long-only deep value arena that sometimes, and many times in fact, outperformed long-short equity strategies also. That said, we also like risk arbitrage and merger arbitrage and the convertible arbitrage area also. These are strategies that have served investors very well, even though in recent years returns have been low.
Difficult.
Yeah. And I think that that's because the predictability of the returns in that space is such that it is a function of interest rates, and because we have been experiencing low interest rates over quite a few years now, the returns have been low, but they are predictable. They tend to be very steady, and they tend to make good cash alternatives in portfolios, and they also tend to reduce volatility in the portfolios. So these are the kind of things we look at. We,
Do you approach actually long-only managers the same way you approach long-shorts in terms of analyzing due diligence?
Yes. Yeah, I think one of the characteristics that we like to look at in the, let's say, in the long-short equity space is we like to invest with managers that have really originated in the value investment and even the long-only value category. They have then evolved into being able to short securities also, either as a hedge against their long positions, or in lesser cases where they feel a company is overvalued. But I think in the most part, when you look even in the alternative space, the managers use a lot of the same techniques to analyze company investments, equity investments, etc. That said, though, and I think the industry, well, this is just a personal opinion. I wouldn't be surprised if the industry evolves into, like some of the institutional panelists we heard here, they don't really distinguish anymore between alternative hedge funds or long-only value managers or other, as long as they think that they can deliver the type of risk-adjusted returns that they're looking for. And I think that was the gist of our panel and our discussion today.
Now we've heard quite a lot actually. It's very interesting. Bridging that gap basically, and looking at managers and more sort of equity managers and the way they express their views.
Right. And that also, when we try to say also that we're in the alternative space, we're also very much non-benchmark oriented, and that also entails investing in securities, public securities, that are precisely not in the benchmarks. So they can be a little bit off the wall, and that's also an arena that still I think represents good potential returns, going forward. There are things out of favor and in favor, and hopefully the managers that we invest with are really gravitating to those areas that represent good value and perhaps out of favor. So that's kind of the mindset that we have.
Thank you, Carlo. In terms of pool of talents, do you still believe that there's more talents in the US, or what's your perspective there?
Yes, although I do think that the talent pool is growing internationally. Clearly, we are seeing more and more managers in Asia. There's a tremendous amount of talent in Asia. In Europe, in let's say pan-Europe, we've been very impressed with France, ironically, because France has actually produced some of the best value managers around. Maybe it's because of their long-standing desire to preserve wealth and preserve their own capital. And then still I think you have some very interesting Anglo-Saxon, particularly those originating from the Scottish School of Investing, which is also, and Canada. Canada has produced some very, very, very good talent over the years, and I think that's a name to reckon with.
All right.
And then I think that that we're starting to see some alternative talent rise in the emerging or the real emerging markets. Recently, as you know, Brazil has been cultivating a lot of talent also over there, but I think there we're not really too active there because we want to give some breeding time for the talent to really evolve and prove itself in good periods as well as in crises, and they've done pretty well so far. So
great.
Yeah.
Well, many thanks for this feedback. I think it's interesting at a time where some investors are challenging investing in equities. So you're there for the long term, and you still find value in. We are,
and I really think that we're going through a phase right now, which is, where we've gone through a phase where alternatives in the last, say, couple of years have slightly underperformed traditional markets, but we don't really look at that over such a short period of time. We believe that you have to look at returns over, at the very least, a business cycle, which is sort of like a 3 to 5 year horizon, and then you can make a more educated assessment.
Great. Thanks again for joining us today.
Thank you. It was my pleasure. Thank you, Sophie.